Welcome to Investors Insights. Our topic today, headwinds versus tailwinds. We've got important things to discuss with you today, and I think you'll find it very beneficial as we go into what's really happening in regards to inflation versus confidence in the economy. Joined with me today, my distinguished colleagues, Bobby Norman and Trey Booth. Gentlemen, always fun to be with you. Not only fun, but also insightful. And I really liked our engagement today. You did some incredible research for this vlog, and I want to thank you for it. I tell you what, based on the conversations we had, I think probably, Trey, maybe you ought to start off with to give our viewership some insight about the inflation aspect and the headwinds that we are facing.
Yeah, absolutely. Thanks, Greg. So we kind of teed this up on Monday that we were going to be watching these two reports, which is the CPI and the PPI, which is the CPI is, again, the consumer price index. That's what you hear about on the news on a day-to-day.
Yes.
PPI is the producer price index. So that's what the producers of goods are paying. And so what concerned us for the last few months, you can see on this chart where PPI is orange and CPI is purple, is that the producers' prices were rising above consumer prices. And our concern was, is that a blip or is that a trend? Because the producers are going to have to eat that in terms of their profit margins, or they're going to have to pass it along to the consumer. And so we saw both move higher. We really wanted to see at least one of them kind of buck that trend and move lower. Now they're not at levels they were a couple years ago, not concerning levels. But what it does do is it pushes the likelihood of a Fed rate cut out to the July meeting at the earliest. And so we've been talking since the Fed started rate cutting that they should stop. And so this is enough data really to give them a stop. So that's not necessarily a bad thing because every time the Fed cut rates, we actually saw interest rates go higher. And so this pause should allow the market to kind of digest all the change that's happening. And we may actually see long-term rates come down. But it's something we're looking at closely because this stubborn inflation it seems to be rising again, and something we're going to watch as to avoid that double whammy of inflation coming in one wave, pausing, and then back in the second wave. So we want to keep a handle on that. Want to make sure the policy people in policy power also see that and act accordingly and adjust portfolios. From an individual standpoint, what was concerning is that transport was the highest part of the month-over-month change. You can see here it breaks down inflation by category, and the largest month-over-month was a 1.22% increase in transportation. So that's kind of hitting that bottom line. One of our research partners at Strategas created their own, what they call common man CPI, which includes things that people must buy, not things that people like to buy, like vacations. So it includes things like food, energy, housing, and insurance. The common man CPI is sitting at 3.4%, which is higher than the headline number of 3%. And that's the 43rd time of the last 48 months where the common man CPI has outpaced the broader index. And so it looks like prices on things you don't need are going down, prices on things you do need are going up, and you really want that flipped. And so that's something we're going to watch and see if we can get that flipped. And that's really going to have to be led by energy. And so that's becoming the top topic for us.
Yeah, and I thought it was great that you brought up that common man CPI. I think that's something we've watched closely for some time, and I always appreciate when we share that with our clients who are watching today. So thank you, Trey, for that. And so, folks, you got the headwinds like Trey just talked about, but then also we have some tailwinds. And so, Bobby, elaborate on that.
Yeah, the past 2 weeks and today, Trey's done a great job explaining the headwinds that the market is going up against with tariffs and stubborn inflation. And as always, we analyze the good versus the bad. And while there are plenty of headwinds and reasons for uncertainty in the market, there are also some very positive signs that we consider are tailwinds right now. Two positive tailwinds that we're looking at are consumer spending, which is great, and business confidence. And so first, as you can see in this chart, consumer spending remains very strong and remains a key driver of economic growth and also corporate profits, which is driving stock prices. But the most important variable for spending is employment, and the lack of job losses has been a key support for the consumer. And this matters because 6 to 8% of U.S. GDP comes from consumer spending. And so the other positive tailwind that the market is experiencing right now is small business confidence. You can see in this next chart that U.S. small business optimism has risen significantly since the election. And this is in part due to a more friendly tax policy and regulatory easing. And this matters because hiring should remain stable without big payroll cuts with this amount of optimism from the small business owners. Bottom line is that if both consumers and businesses have this support and optimism, we should see optimism be a strong enough tailwind to fight off the headwinds of uncertainty around the tariffs and the stubborn inflation that Trey just went over. So there's a lot of back and forth here, and we think that back and forth, we should see this for a couple months here as inflation remains stubborn, but corporate America and the consumer remain really strong.
Well, and as we tell people all the time, that's what we're watching. You know, it's we navigate through it, and we're seeing how these tailwinds and headwinds fight it out, as well as what doors open up in moving forward in this economy. So, Bobby, great examples there and great data on this. I'm sitting here as I listened to both of you, and as we had our meeting earlier today. Today is February 17th. I've had the honor of working with both of you for 10 going on 11 years. And on February 18th, tomorrow, this Tuesday, February 18th, we will celebrate 20 years here at Five Plan Partners. And I think about all the headwinds and tailwinds that we've been through. That our doors opened on February 18th of 2005. And here we are 20 years later, having gone through the '08 downturn, the financial crisis, and also 2020 COVID, as well as throughout all of it, the variety or shall I say volatility that's occurred, and we've navigated through it. I want to thank each of our clients who've been with us, not only just from the very beginning, 20 years, but throughout our history. We cannot thank you enough. And hopefully from this vlog, as well as others that we've given you, it's given you confidence. As Bobby was talking about confidence in the consumer and the corporation, it's given you confidence as our clients to know that we're staying on top of it, that we're going to communicate with you in a variety of ways. I think about how we first started and we weren't using Facebook, Twitter, LinkedIn, YouTube, a podcast or anything, and we continue throughout our history to expand on that, as well as the one-on-one meetings and telephone calls and WebEx and Zoom meetings. But in addition to that, we're looking forward to the next 20 years, and we're looking forward to informing you throughout all of 2025 about these headwinds and tailwinds and how we're going to every day make sure that our clients have a better, richer, fuller life. We thank you for the opportunity. Happy President's Day. And then we hope you have a great week. Keep the questions and emails coming our way. Talk soon.